Welcome to The Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, as always, I've got my two fellow Investing Show musketeers, Richard Hunter, Head of Equities at Hargreaves, Lansdown.
Hi, Simon.
And Nick Moose Batsford, CEO of Tip TV. Coming up later on today's show, we've got Micah Curry, Associate Director at Fidelity Worldwide Investment, who's going to talk to us about emerging markets and why it's time for investors to be a lot more selective and not just think in terms of those big sweeping acronyms that we've got used to over the past decade or more. But first, a quick look at some of the things that have been in the news. Richard, something that is always at the forefront of many UK investors' minds, especially with this decision last week from the Fed to keep interest rates on hold, dividends. Now, tell us a little bit about those.
Yep, it's a story that's not going away. You've got retail and professional investors alike still chasing yield. Obviously, you're getting next to nothing on cash. Interest rates in the UK, for example, historical average 4.5%, going back all that way to 1694 when the Bank of England was formed. Even when we do start to get rates rising in the UK, it's clearly going to be some time before we get back to even the historical average. So, with that particular theme in mind, what we thought we'd do is have a look at the FTSE 350, the FTSE 100, and then the FTSE 250 index underneath it, just to see where some of the dividend plays could be. Now, obviously, you're not going to invest in a company in dividends in isolation, but given the importance of dividends, and particularly reinvesting dividend income, it was probably a worthwhile exercise. Now, having started with the FTSE 350, we put a number of filters in place, a number of screens, just to whittle the numbers down. The first of which was that shares should be yielding 4.5% or more. The current average for the FTSE 100 in terms of dividend yields is 4%. For the FTSE 250 is 2.6%.
So we're looking at shares that yield more than the market here.
Yeah, that's right. And then the second one was that the dividend yield that you will see is the current dividend yield, and despite the name, that's actually a historic dividend yield. So what it won't take account of, if a company has recently made public, for example, it's going to have a dividend cut. So we've also fed in the projected yield, what it's likely to be, taking those things in mind. And so that parameter was that the projected yield should be roughly equal or more than the current yield. The third thing we put into the mix was dividend cover. This is the ability of a company to pay dividends. If it's anything under a figure of 1, it's coming out of past earnings. Generally speaking, 1.5 is seen as the sort of dividend cover figure that you want.
And this is the bit that says to an investor, my dividend looks fairly safe.
Absolutely. And the final thing was, okay, so if we're going to identify some stocks that have passed all the hurdles so far, it's probably just as well, or an added bonus, if the market consensus for those particular shares is also positive. It's all very well having a company whose dividend is safe, but it's a raging sell in market consensus terms probably defeats this particular object. So what we started with was 350 stocks, and if we pull up the slide, what we ended up with was 6.
Wow. That's a pretty good screen.
Not only that, of those 6, only 1 is in the FTSE 250. UBM, it's a media group, United Business Media, I think they used to be called. The only reason I mention what index it's in is, of course, you can have some volatility and less liquidity in trading the indices further down. And again, in terms of some of the others on that particular list, you can see that UBM is something of a tiddler. Also, of course, in terms of the projected yield, that's slightly under where they currently are, but we just about let that one through. But as you can see, bearing in mind current interest rates in the UK being 0.5%, there are some fairly punchy yields there, on top of which you've got that dividend cover passing the test, on top of which they are something, they are stocks that are fairly well regarded by the market as well.
And I was going to say, the big question about Shell at the moment, isn't there, is like whether that yield will remain, whether that dividend will be cut. Now, Shell is one of those companies, correct me if I'm wrong, but I think it's got a very long history of not cutting its dividend, hasn't it? So it's going to do everything it can not to do that.
You're absolutely right. And furthermore, in the last couple of quarterly statements we've had, both from Shell and BP, incidentally, the chief executive has been at pains to point out that in terms of their financial strategy, the dividend is first and foremost in terms of maintaining it. So you can imagine that because of the sheer size of the company, virtually £100 billion there, you would imagine that the dividend cover of 1.6 is there for a reason. It's just enough to pass the hurdle without wasting any other earnings, but by the same token, very punchy yield.
I was sure in the back of my mind it's something like £1 in every 9 of total UK dividends paid out are through Royal Dutch Shell.
Could well be.
It's an
yes.
Extraordinary number.
Given those numbers. And of course, prior to the, although the market cap at the moment is around 100 billion, prior to the recent tribulations we've had with the oil price, it was sort of 150, 160. And even at 100 billion, of course, that's also before the BG Group, should it go through all the regulatory hurdles, be added to what would be a larger combined company.
If we look further down the scale with some of those companies, are they ones that we can expect to maybe deliver a bit more growth than the really, really big companies, do you think?
That's what would tend to happen. That's what you would expect to happen, which is why the FTSE 250 average yield is just 2.6%. I suspect if you went down one stage further to AIM, it would be next to nothing, because these are fledgling companies, they're smaller companies, they're more likely to be reinvesting any profits that they make into the growth of the company as opposed to paying it out in dividends.
And if you look at some of those AIM companies or small cap companies that are paying a dividend and still growing, they've got really good prospects and a nice, cash on the balance sheet kind of thing. You're only looking at a yield of maybe 2% or at the most, aren't you? So it's you're giving one of these things up to get the other.
Yeah, absolutely.
Now, hedge funds, smart investors, very smart investors, cost a lot of money, or are they, Moose?
Well, this is the newspaper review. I don't get to see articles like this very often in the Financial Times. A gentleman by the name of Matthew Vincent, big headline, hedge funds merit a place on shelf of perfect misnomers. If there was a product that failed to do what the name suggests, it's a hedge fund. Quick recap, what's a hedge fund? Because lots of people don't really understand the terminology. They're pooled funds that basically use a number of different strategies in order to generate a return, and that's known in sort of technical jargon as alpha. His point, in August, the S&P fell 6% and all kinds of hedging strategies and managers provided they were basically unable to make any money, and they had big losses. Hedge fund research, majority of investors in hedge funds lost money in August. His point is, does the short term matter? One investor told the FT, according to this article, they're not really hedge funds because they charge incentive fees. No fund gains 20% in 7 months and loses 7% in 1 month can be meaningfully hedged. It's simply betting big stakes frequently on often ill-judged wagers. Hedge funds need to be explicit. Sorry, they don't need to be explicit on this. And the point was, he reckons that global regulators don't care. Managers take 2% fees on tens of billions of dollars every year, whether they're right or wrong. And lastly, if you look at the actual numbers at the moment, to date, European equity long-short funds have returned something in order of 7% on average year to date. Where in the US, they're up just 1.4%, and that was data by Financial News. So he's basically saying they don't do what they're meant to do. They're not hedging, okay? They're not basically protecting people's money when these markets move south.
And I think a lot of people think with hedge funds, they think, well, this is a problem for the rich, isn't it? It's only the rich who can invest in a hedge fund.
Well, they are sophisticated.
But there's a lot of institutional money that's gone into them over the last decade or so, isn't there? Sort of big pension fund money and stuff like that. And so people do need to look at these things and think very carefully about them.
I also seem to remember, I mean, we're going back maybe 25 years now. There was, in the earlier days of traded options and the like, it wasn't unusual for a quite straightforward strategy to be the 90-10. So you would probably have 90% of your portfolio long, let's say of stock, but the other 10% would be quite aggressively short. So that in theory, if the market were to fall out of bed, although you wouldn't recoup all of your losses, the fact that you were aggressively short would cover a lot of those losses, and that's pretty straightforward, and that was 25 years ago. So it does come as some surprise that there doesn't seem to be any hedging within hedge funds.
I think finally on that, there was another article in the FT recently, basically an AIM fund manager for the small caps. They weren't highlighting his performance on the actual AIM securities. It was on the put option, basically the bet he had on the market moving south, okay, and the fact it was costing him money to roll over to protect the portfolio. Yeah, that was hedging.
That is hedging, yeah, indeed, indeed. Well, coming up after the break, we've got Micah Curry who's going to talk to us about emerging markets. But first, the money tip of the week. Now, many people have flocked to the Santander 123 account in recent years, attracted by some very, very attractive perks, such as cashback and interest. Unfortunately, they've now found that Santander is going to raise their monthly fee from £2 to £5. Now, this makes it a great time that if you are one of those people who's moved to Santander, to look at the account and make a decision as to whether you still think that this is going to be a good deal for you. Now, for some people, it will remain a good deal, just probably not quite as good a deal as it was before. But for others, it might be that actually the amount that they're now paying for it is wiping out any gains that they were getting. There's been a big backlash against this, but what I would say is don't fall victim to inertia. Do take a look at your account and consider whether the Santander 123 account is still the right one for you. And if you think it isn't, go off and find a better one. This is Money's 5 of the best bank accounts, has got a rundown of what we think are good accounts, and the Santander 123 account was in there, and that's at thisismoney.co.uk/current. Join us after the break for a discussion on emerging markets. Welcome back to the Investing Show. Joining us here in the studio, we've got Micah Curry, Associate Director of Fidelity Worldwide Investment. Now, Micah, you've come to talk to us about something that is rarely away from the headlines for investors, emerging markets, and it's been very much in the headlines recently with the fallout from China, crisis, emerging markets suffering, and people asking this question seemingly for the 100th time in the past 2 years. Are emerging markets still a good bet? Now, your argument is people should be a bit more selective about this, I think. But first of all, can you tell us what's happened in China and why are emerging markets suffering?
Well, I think the key thing to remember about China is that what we've seen is a slowdown. It's not a meltdown in the economy, and an economy which has seen such major growth, there was always going to be a bit of a slowdown. We also saw the stock market rally enormously up until June, so there was always going to be a correction. Now, the key impact on emerging markets is that China has been this big consumer of commodities, and as we know, a lot of emerging markets are exporters of commodities. So that's one factor weighing on emerging markets. The other factor, of course, is the prospect of a US interest rate rise. Now, Janet Yellen did kick the can further down the road, but once US rates rise, money will flow back to the US, money that's been seeking higher returns in emerging markets. And then, of course, the slowdown in China.
So, does that mean that for investors, this whole emerging markets idea is just a dead duck? It's dead in the water, move on somewhere else?
No, I mean, for very long, emerging markets were the growth darlings of investors, and for the, since the dawn of the millennium and for the first 10 years, the argument was that you could go to emerging markets for growth regardless. Now you've got to be increasingly selective, and I think the danger is that with emerging markets, we always put them under these banners of BRICS or the Fragile Five. Increasingly, what you need is selectivity, and stock picking really is key.
And so for investors looking at emerging markets, where do you think the best opportunities lie at the moment?
It's a good question. If we look at the BRIC economies, now these are 4 economies that have been put together, but they can't be more different from each other. If we take China and India, these are polar opposites of each other. Now, India is a democracy, allowed democracy. China is a single-party state. China has been heavy on manufacturing and infrastructure, where India has been quite heavy on the service-based economy. I think an interesting bright spot in the emerging market universe is India. And a lot of our fund managers at Fidelity, in Asia specifically, are overweight India because of a number of factors.
I mean, India saw a fantastic run, didn't it? Going back, it was last year, wasn't it? The first half of last year and a lot of last year, but then it came off the boil, I think. So I guess with markets like India and China, what do you do when a market's gone up by that much? That's the question investors always ask themselves, isn't it? I've seen my fund go up by 20, 30, 40%. This is a great problem to have, but what do I do now?
Emerging markets very much is a long-term investment, so you've got to be in it for the long run. India has that massive rise we saw. It has slowed down a bit, but it's slowed down much less than other emerging markets. And it's important to look at the fundamentals. What is playing in India's favour? And there are a number of factors. One is demographics. So if you compare India to China, India is a populous country. Its population is growing. China, because of the one-child policy, the population is not growing. It's an ageing population. Then, of course, India is an importer of commodities, so the fall in the oil price benefits India, which imports about more than 80% of its oil. So that's a direct benefit to its consumers. And then India is not as linked to the Chinese economy, so it doesn't compete as other Asian countries do with China when it comes to exports. So quite a number of factors that make India an interesting investment.
In terms of what could happen in the future, there's also been something of a political change, hasn't there? That's right. Which could also improve some of the bureaucracy, which maybe has held India back.
So the election of Prime Minister Narendra Modi, with his pro-business reforms, was welcomed by investors. Of course, there's still question marks, and that is about the speed of reform, and bureaucracy is a big issue in India.
I think that what's interesting about places like India and even China, which you can say, well, it's got a lot of household debt, it's probably got quite bad demographics, but then they do have this shift towards this emerging middle class, don't they? And it's the emerging middle class that goes out and spends all that money, that fuels that consumer economy, that really, drags things along. And you can look back at similar, stories from the investing past and say, well, actually, that country did very, very well. And some of those countries their stock markets did much better after some of the actual GDP growth had tailed off a little bit, I think.
That's key. I think the one thing that we've learned about emerging markets is that the economy doesn't reflect what's happening in the stock market and vice versa. The key thing is that emerging markets are still a big proportion of world GDP, rising middle class, favourable demographics, abundant natural resources. There are a lot of reasons why you can still like the region as a whole, but it's very much about stock picking and not a blanket coverage of the market, finding quality companies.
I was just going to say, the thing that fascinates me is the data coming out of China, what we understand to be accurate and not accurate. Everyone's talking about the Chinese GDP not being 7%. Is there anybody on the planet who actually knows what their GDP is at the moment?
I think there are lots of question marks about the data out of China, but inevitably when you look at things like electricity consumption, you'll get an idea that, yes, the economy is slowing, but the fundamentals still remain there.
Yeah, actually, I was reading something only today on my way over here, I think in the FT, saying about some of those, talking about the numbers in China and this questioning of them, but saying that if you look at some of the underlying consumer data, some of the sales data and things like that, it does seem to support the idea that the economy is still growing and it's not sort of growing at a much, much slower pace like some of the the critics say about it.
But the flip side is the Chinese market's down 40% since June. It's wiped off the market cap of the FTSE 100, which is great if it's not my money.
And I think that's where a very important point comes in, doesn't it? And that is diversification and asset allocation. If you are an investor, a UK investor, private investor, our viewers, thinking about investing in emerging markets, how much of your portfolio should you be looking at putting into this kind of thing?
Well, it depends on how much risk you're willing to take, as always, because these are viewed as more risky investments. But look for a stock picker, look for a fund manager with experience. This is where active management really does pay. And then look for exposure to companies with a bit of internationalization of earnings. So they're not reliant just on domestic issues. Companies that are innovators, and of course managers who can take volatility and seek out opportunity. So I was speaking to one of our emerging market fund managers who pointed out Saudi Arabia. Now that market has just been opened up to foreign investors in June this year, and you'd think when you hear about Saudi Arabia you'd think oil, but they're actually finding interesting opportunities in the healthcare space, because a lot of Saudis have quite a sweet tooth, quite an appetite for sugar, which means that more than 20% of the adult population suffer from diabetes. And of course, this is a disease that you've got several symptoms that need to be treated. And that opens up massive opportunities within the pharmaceutical and healthcare space. Likewise, Turkey is another economy that's been under the cosh, but Turkish banks are looking quite interestingly. So very selective, sort of on a country basis and also on a stock basis.
Yeah, and I think that's where it does, I think, in this kind of instance, pay to look for a good active manager. It's you could go out and you could do this passively. You could go out and you could buy a tracker for one of these indices, but you are getting that entire index, and you're getting the good stuff, and you're getting all the bad stuff. And I think you need to be very selective about choosing that manager and looking for someone who is, got a clear plan, that they're outlining what they're doing and where they like to invest and what they're looking for, because I think that diversification really matters to people. And I do think that sometimes with these stories like emerging markets, it can be very easy for people to get caught up with them and put far too much of their money into an asset like that.
And also the support in terms of analysts on the ground doing the research, finding those opportunities, and who actually know the market. Because we know emerging markets can be a minefield when it comes to things like political risk, corporate governance risk. So you really need the experts to sort the wheat from the chaff.
So the big emerging market, obviously, that we touched on with the acronym, but that's also been struggling, is Brazil. What's been happening in Brazil recently?
Well, a few things have been going wrong. And if you look at Brazil, Brazil would dream of having the growth that India has. Of course, it's in a technical recession at the moment. It's got a lot of issues around politics, and it is a key exporter of commodities. And because we've seen commodities across the board collapse, Brazil is really suffering.
Which highlights why you need to go for possibly individual letters of the acronym and not
the whole suite.
As a whole.
Or
Absolutely.
catchy acronyms are a thing of the past.
Indeed. Micah, thank you very much for joining us. Richard, thank you.
Thank you.
Nick, thank you. Join us next time on The Investing Show.